Welcome to the show. I'm Mike.
I'm Maggie.
And this is Friends on Fire.
We are a podcast on a mission to get friends to talk about money. I think we're like 20 episodes in now, and I can finally say that without reading my notes. So I'm feeling pretty good that I can memorize 10 words now.
I'm proud of you.
How you enjoying that chocolate protein smoothie I made you?
It's pretty good. I mean, in typical Maggie fashion, you really sold it. And it's not like, I wouldn't describe it as a disappointment.
Well, I said, do you want a chocolate? A, I was providing you a snack. B, I was like, do you want a chocolate protein smoothie? And you were like, I don't like protein smoothies. I don't like the taste of protein. And I was like, oh, this doesn't taste like protein at all. And then I whipped it up, and it's like my famous recipe. I made it up myself.
Yeah, but then you were like, my kids love it. We make it all the time. I'm like, fine, just get you to shut up if I drink your smoothie.
And then I made it, and I tasted it, and I was like, oh, yeah, maybe it does kind of taste like protein. It's delicious. It's just frozen bananas, soy milk, and chocolate protein powder.
It's pretty good.
Yeah, it's good. And honestly, like the kids love it. You saw, I gave the kids some. You see how excited they were. They kept trying to take Mike's because he had a much bigger cup than I gave them. And they kept saying like, well, like, can I have that one?
Yeah, so, I was surprised by how much they enjoy these protein shakes. You really got your kids trained well.
Yeah. Well, frozen fruit in general, like frozen bananas are an amazing, you could just turn them into like any smoothie and the kids think it's like a milkshake, ice cream, etc.
We do that too.
Yeah.
So we save all of our bananas and then blend them up in ice cream.
Yeah,
Kids
I
love
like it. We'll talk about that on our next week's episode.
Oh,
Crazy frugal things we do.
This isn't, bananas is not the topic of our
bananas is
episode.
not the topic of this show, but we are going to talk about 401ks.
Which is equally as exciting.
Yep, right up there with taxes and car insurance. Let's talk about 401ks.
All right, so 401ks, also 403bs, if you work in a nonprofit, they function in the same way.
What is a 401k, 403b, etc.?
Okay. Retirement savings plan. So it gives you a tax benefit. You get to invest and then use it for your later years. Before we get into some of the specifics, we need to point out we're not financial advisors. So we're going to explain how 401ks and 403bs work. But once you get into what investments you make within these accounts, if you're unsure about what to do, contact a professional.
Got it. Just to be clear, you're the one I ask for all my advice. So
yeah, but we have an agreement that you're not going to sue me if you lose all your money.
Exactly.
Investments,
it's a loose agreement, but yeah, it's an agreement.
Investments have risks, and you need to understand what those risks are. We talked about this a little bit on our tax episode, but a 401k is a tax-deferred savings account. And there are some variations which are tax-free, which we'll get into that in a second. But tax-deferred means that you put away your gross income now. It reduces how much is taxable in the present. And then in the future, when you withdraw that money from your 401k account, then you are taxed. And the idea is that you save money now, it grows tax-free, and then hopefully you're in a lower tax bracket in the future, and you've made, in addition to what you've grown, you've made some of the savings in that difference in tax rate.
There's a lot of different benefits of 401k. It reduces your taxable income. It has you pre-saving for the future, and that money is going to earn interest and grow over time. So you're putting it away earlier, and you're getting a tax benefit. There's probably more benefits.
Yeah. The big one and why companies utilize this is that they provide you a match. And this is probably the highest return on investment opportunity you have, because for every dollar you put in up to a certain limit, the company is going to give you another dollar.
It's free money. It would be ridiculous to not put in the amount that your company matches.
Yeah, it's a major lost opportunity. So typically it's 6%. It could vary a little bit, and your company might have...
I've heard of companies that go as high as 10%.
That's amazing.
Yeah. So it could, whatever it is, you should totally take and match whatever your company is matching. Even if it means you have to go to great lengths to reduce other expenses in your life. Like, it will pay off. And the younger you are, the more important it is to do this.
So if you make, let's use easy math, $100,000 and your company has a 6% match. If you put in 6% of your salary, so
Which is how much?
$6,000.
Thanks.
The company will give you $6,000. Now, again, all companies have different rules, and there could be a slightly different percentage which they are matching, but for simplicity, this is the way most of them work. You have saved $6,000. You don't pay taxes on that $6,000, which there's some savings there, and then the company gives you that match. And so this is a huge opportunity, and this should be the bare minimum that you should be participating in. It's an opportunity too good to pass up.
Just to clarify, the bare minimum is what your company is matching. Even better is to do the max, which we'll get into in a little bit more.
And so, Maggie, when you're talking about the max, you're talking about the IRS max. The government won't allow you to reduce your taxable income entirely. They will limit that benefit to $19,500 for an individual in 2020. This number changes every year typically. The company that you work for might only give you a match up to 6%. The government will allow you to deduct up to $19,500.
And that part's not a percentage. That's a fixed amount.
That's right.
And so whether you make $50,000 a year or $100,000 a year or $200,000 a year, we all have the same max in the United States, which is $19,500 for the 2020 calendar year.
And that should be, if you're not there yet or you're unable to get there at this moment, that should be your goal. You want to make sure that you're taking advantage of all the tax opportunities the government's giving you.
We actually, I don't know if you remember, Mike, but in one of our earlier episodes, we had a call in from someone who was younger and was asking how they maximize things like 401k and other stuff when they have all these other like early in life expenses, like saving for a house and getting married and all these other things. And, my advice to them is the same thing I'll say again now, is the younger you are, the more important it is to put a lot of money in your 401k because it's going to grow that much more over time. And so challenging yourself to really think, how can I get as close to the max if possible and or max it out, I think is really important and can be one of the biggest things you can do to secure your financial future. People who think they can't hit the max, I would, we just did an episode on expense tracking, like I would think about where your money is going. And, if you have a expensive car, if you think you're saving for a house, all these other things, I actually would prioritize maxing out your 401k before any of those things. I'd own a cheaper car. I'd not worry about buying a house so much. And I'd just make sure that I, minimize my rental or housing expenses. But I just don't think we can stress enough, like how important your 401k can be.
And it's, to your point, especially important when you're young. A lot of people think that I'll just wait until I'm older or wait until I'm earning more money to save. And that's probably true. If you're 50, you're in a different part of your career, you have different expenses, it will be easier to save $10,000 than it would be when you're 20 to save $10,000. But the growth you get from that additional 30 years will be huge. So the more you can make impactful changes now, the more money you're going to have in the long term by a lot. All right, let's talk about some myths. First myth, 6% is the quote unquote max.
And you're saying 6% as if it's your company's match.
Yeah.
I think some people, you're right, think, well, my company is going to match X%. That is what I'll put in, and that's all I need to do.
And a little story, it wasn't until a few years after I started working in corporate America that I understood this. Keep in mind, I've been on a FIRE journey my entire life. I understand personal finance, and it didn't occur to me that 19,500, or at the time, I think it was 18,000, was the max. I thought what the company allowed you to put in to get a match was the actual match, the max of the program.
Wow, it makes you seem like a real person, Mike, all of a sudden. Like even you made financial mistakes.
Yes, it was brief.
Yeah.
And then I corrected it. The other myth is that 6% or whatever your company matches is quote unquote enough to get you to retirement. And that's really not the case. You need to be aggressive in your savings for retirement, especially if you want to do so early. The idea that you take advantage of kind of the minimum available to you through your company, it probably won't get you to where you want to go.
Yeah. So if those are the myths, let's just recap the truths, which we've been talking about. 19,500 is the max for 2020 of how much you can put in. That should be your goal of how much you want to put against your 401k this year.
And the other truth is that the amount that your company matches is...
You should really think of it as the bare minimum.
Right. So another myth that I think I probably see more than most people because I read a lot of information online is that by a certain age, you should have a 401k balance of X number of dollars, or the average 401k balance for all Americans is some dollar amount. And that's what you should be basing your performance on. And that's just crazy for a couple of reasons. One is that people are at all different ages. So let's talk about the one where it's the average 401k balance for all Americans that you might see. And it's really low. A lot of people are going to have zero. a lot of people are going to have $1 million because they've been working a long time. The average is meaningless to you. If you see a just total average, please ignore it. Don't base your decisions off that.
At that point, you might be comparing yourself to something that really isn't a good goal.
Yeah. So you have bad savers, you have good savers, you have young savers, you have old savers. The average doesn't mean anything.
Also, who wants to be average? You know?
Exactly. If you're listening to this podcast, hopefully it is your intention to be above average.
Nice.
So the other thing that I see a lot is a average, or perhaps what's referred to as like a target 401k balance by age. This is also misleading because even though you might have somebody the average is 30 and your age is 30 and you want to compare yourself to that, that person might not have had a 401k available to them for the same amount of time you have, or their salary was significantly different than yours, and so how much they had matched by their company and contributed was different than yours. When you look at an average by age, it is still, I would argue, pretty meaningless to your own situation. The only thing you can control is to max it out and be careful with your investments.
One other tip that I think is worth sharing is if you're in the category of people that are going to want to max out your 401k to the 19.5 amount, make sure you understand the rules of how your company pays out the match, because most companies pay it out per paycheck. For example, if you were to think, oh, I'm going to be really aggressive and I'm going to hit the max in June because I just want to save early and, get it all out of the way. You wouldn't actually, once you hit the max, they cannot take any more out of your paycheck based on the government regulations. And so you would be missing your company's match for half of the year. More realistically, you might have just not done the math well and you hit it a month before the end of the year. You're missing out on that match for the last month. So it's super important that you make sure you time it properly and do the math to make sure that you adjust your percentage throughout the year. Like sometimes you get a raise a certain part of the year and you need to kind of see how much you've already put into your 401k and how close you are to hitting that 19.5 number, and then make sure you evenly split it out through the number of paychecks that are left in the year. So sometimes you got to kind of I'll check in on my 401k a couple times throughout the middle of the year and then kind of towards Q3 to just see where I need to adjust my percentage. And I've heard of people who have made this mistake and who have missed out on the company match, and there's just nothing you can do about it other than learn from it. So learn from other people's mistakes and make sure you don't do that.
It's a good call out. The easiest way to do this is to understand first, is a 401k contribution also coming from a bonus you might receive, or is it just your base salary?
Oh,
if it's
point.
just your salary, you take whatever your target contribution, let's say $19,500, and you divide by your gross salary. Let's say you make $100,000. And so you would want to contribute 19.5% per paycheck.
Did you just do that math in your head?
I mean,
okay, keep going.
It's pretty easy. 19.5% would get you exactly to the target you want, and you wouldn't miss any match. You wouldn't be penalized. The math is not hard to get to the right contribution, but you need to spend just a couple minutes thinking about it.
Mike, one thing that I think might be interesting for you to briefly speak to is just the rules around when you can access the money that's in your 401k.
Yes, great point that I wasn't intending on talking about.
I know, I just realized we weren't. I think we assume some people know this stuff, but we should really cover it.
Yeah. Thank you, Maggie. You can withdraw your 401k balance at age 59 and a half. This is to avoid the penalty. So if you would withdraw early, so if you withdraw at 40, there are a couple situations where the government allows you to do this under
hardships?
Hardships.
Okay.
You can also take loans, but I don't really advise doing any of those. If you withdraw before 59 and a half, you'll pay a penalty. If you withdraw after 59 and a half, it is penalty free, but then you pay ordinary income taxes on it. And hopefully you're in a lower tax bracket than when you contributed and saving. That's the real key here. But the idea is you save this when you're 20, you're not going to touch it until you're 60 and beyond.
The reason I wanted you to talk about that, Mike, is I do think there's some people where if they were to max out their 401k, which again is what we're challenging you to do, even if you make $60,000 a year, we're challenging you to think about what you could do to adjust your lifestyle to max that amount out. But if you do that, you're basically forcing yourself to save up front, and you're kind of hiding your money away to where you can't get to it until later. The thing that I think is worth noting, though, for anyone where that makes you kind of nervous, if you did need to get to that money and there was an emergency or a hardship of some sort, you could access that money. You're just paying a penalty for doing it. But we still would encourage you to, as aggressively as possible, save into your 401k. And know that if you had some, terrible emergency, you could tap into it before you're 59 and a half. But the end goal is to not touch it until you're actually at that age. Also, I'm always super curious, like what meetings were people sitting in where they decided, they were like, well, should it be 60 when people can take it out? Should it be 59? And at some point they were like, well, look, we can't agree. Let's do 59 and a half.
It's the most logical answer.
Yeah, right. I mean, I feel like it should be 59 and like 1/4 personally, but whatever. I didn't get to vote on that one.
There are some differences in 401k accounts. So when you, hopefully after the show, you will log into your company benefits website and look at your options, make some changes. You're probably going to see...
The cool thing about 401ks too, sorry to cut you off, but I just did, is you can make changes to your 401k throughout the year versus other things like HSA and other things. There's only like a one-time yearly benefit election into it, but you can change your 401k now. So you're not locked into anything.
Right.
Keep going.
Thank you. There are multiple types of 401ks. I don't have any stats on this, but I think most companies will only offer a regular 401k. But a lot of companies will offer what's called a Roth 401k or an after-tax 401k. They are 3 different programs.
What's the 3?
An after-tax 401k is
it.
different than a Roth 401k, which is different than a 401k.
Okay.
You're probably going to get a Roth 401k and a regular 401k. Roth means that, like a Roth IRA, you put the money in after tax, but then it grows, and when you withdraw it later in your life, it is tax-free. You no longer pay taxes on it. The way this benefits different people and the way they have options versus just forcing you into one is that you want to be saving the highest tax rate you will have. If you are paying super high taxes now and you think they'll be lower in the future, you want to save on the high taxes now. And that's a regular 401k. If you think that you are in a low tax bracket now, like you're earlier in your career, and you think that when you're in retirement, you'll have more money, more income than you do now, that's where the Roth comes into play. Because you have this tax arbitrage situation where you want to be saving the high tax rate and paying the low tax rate. You don't want the reverse of that.
Will you tell me if what I'm saying is right, Mike?
Okay.
I want to take a stab at rephrasing that for those who might have heard what Mike just said and like, it just like, they were like, I don't know what he just said. Which, just to be clear, isn't me. I just feel like there could be someone out there who's thinking, I have no idea what that dude just said.
Understood.
If you're in that category, basically when you're deciding between a regular 401k and a Roth 401k, and same thing with IRAs and all that, you're kind of making a bet on whether you'll be making more money now or later, right? You don't know, you're just guessing. You're making a forecast of which tax situation will be more advantageous and what your salary will be now versus later. And again, you don't know, but you got to make your best guess as you choose which vehicle makes sense for you.
Yes. Technically speaking, the way the math works is that you would always want to save wherever you think your tax rate is going to be the highest. However, there are lots of reasons why somebody might choose a 401k if they are unsure what their tax rate is going to be, or they think it might be somewhat similar, or they think it might be higher in the future. Once you pay taxes now and you put it in your Roth 401k, you never pay taxes again. That's very easy to forecast. You know how much money you're going to have. There are benefits to doing it this way. Again, this is one of those situations where, like, if you are unsure about your personal situation, what to do, talk to a professional about it. They will have some advice based on your specific situation, and you can make what decision is best for you.
Also, if you feel like talking to a professional is intimidating, sometimes I like to talk to Google. You can Google this stuff. There's some great articles out there. So
there is so much information about Roth 401k versus regular 401k. You will not be disappointed if you do some
research. It can actually become overwhelming because there's so many different points of view out there.
Yeah.
Okay. Should we recap?
Yeah, let's do a recap.
Okay. For those who think we just like make up the stories at the beginning of this thing, I just wanted you to know we're really drinking chocolate protein smoothies right now. And I just finished mine. Delicious.
And I really found it to be just okay.
Yet free, which always makes it taste a little bit better, don't you think?
Yes. All right, let's recap this.
Number 1, participating in a 401k is the absolute bare minimum. You should at least be participating and putting in the percentage that your company matches. That is the bare minimum.
Second point, try to max it out. Make that goal and start right now. The younger you are, the better it will be because you have longer for that money to grow in the market.
Sacrifice now for the future. Might feel hard, you can do it.
And then the last point is that the 401k is just one piece of this entire puzzle. You have to be reducing your expenses, like our previous episode about tracking your expenses. You have to be smart about your mortgages. You have to be smart about all these other tax situations that are available to you. The 401k alone is not going to get you where you want to go, especially if you're listening to the show and you want to be aggressive and you want to retire early. You have to be doing a bunch of different things. This is just one piece.
Okay, thanks. That was a great discussion on 401ks, and I hope it has inspired people to ensure they're matching their company's match and striving to be able to max it out now or over time. Okay, let's move on to Mike's Minute on the Mic.
I'm ready.
I got a quick question. You have 60 seconds. I'm going to practice my goal of not interjecting during your 60 seconds, which is the most difficult part of this. Okay,
Yeah.
Mike, on theme for this, I know you admitted earlier that in the very beginning you weren't even, or no, you were doing what your company matched, but you did not ever think about maxing it out. You just didn't cross your mind.
The IRS limit, that's right.
Okay, so how long have you been maxing out your 401k?
Oh, that's a good question. This is sort of a softball because it's like a single part answer. I think it would have been in 2011 because I got out of business school and started working in 2009. So it's 2009, 2010. Then I figured it out in 2011.
Okay. That was 20 seconds. That's pretty good. Also, do you want to compliment me? I didn't talk once.
I only talked for 20 seconds.
Yeah, I know, but that was 20 seconds that I didn't talk, which doesn't happen during the other Mike's Minute on the Mics.
All right. Congratulations, Maggie. Thank you.
Thanks for sharing. I'll answer that question too, because it's a quick one. I've probably been maxing it out, I think, for about 5 years. And so that was when I was about 34 or 35 that I started. And I could have done it much earlier. It didn't cross my mind at the time. I don't know, for whatever reason, I just wasn't thinking about it. I was saving a lot of money and I could have put more towards it. I don't think I was as focused on reducing my taxable income and just thinking about it. So
it's not generally advertised. So for people who might feel bad that they've missed this opportunity, it's not something that you find printed in bold letters in a lot of this material. Unless you're kind of looking for something, you probably wouldn't know.
Yeah, true. Okay. Well, thank you for listening to our show. As always, we would love for you to leave us a review on iTunes or wherever you are listening to this podcast. It really helps us. We love to hear it, and it helps other people find our show also.
And if you have some feedback, you can give us a call or text us at 404-981-3370. We'd love to hear from you.
You can also find us at friendsonfire.org if you want to check out the latest episodes or leave us a message. I think our next episode is on some of the crazy frugal stuff we do. I think it's going to be a fun one.
Yes, much less technical. I'm looking forward to it.
Yeah, okay. Thanks, Mike.
Thanks, Maggie.
Bye.
Bye.